Hello, my name is Alex Duffy, the Portfolio Manager for the Fidelity Global Emerging Markets Fund. Today we're going to recap the investment universe for global emerging markets, touch on the key opportunities that we see presented by emerging market equities as an asset class. We'll discuss in a little more detail our approach to investing in the asset class, how we seek to generate stock ideas, what that means in terms of the type of ideas that you find within the portfolio. We'll bring that to life with a key stock example and then briefly touch on the outlook for the asset class as we see it today. Now, it's important to remember the significance of global emerging markets to the broader investment universe. As we sit today, global emerging markets consist of around 60% of global economic output, so they are significantly material in terms of their contribution to global GDP. Of incremental economic growth globally, emerging markets are more significant. They're around 80% of incremental global GDP output. Now, despite that, they still represent a relatively smaller proportion of global equity allocations at around 11% of an MSCI global world portfolio. And so whilst these are very large markets, they are very large and growing markets from a demographic perspective, they are still relatively underrepresented in the majority of equity market portfolios. And I think that's an important consideration to keep in mind as we think about long-term investing and how these markets become ever greater parts of global portfolios over the long term, and therefore, whilst they may not be the forefront consideration for all investors today, in the future they are undoubtedly likely to become more important to asset allocation and portfolios. And that's why it's important to really understand these markets in some great detail and understand how best to access the investment opportunities that they present us with. So with the Fidelity Global Emerging Market Fund, from a philosophical perspective, we keep things relatively simple. We really just want to own good businesses that we understand, and we want to own those businesses for as long as we possibly can. We're very clear on how we identify risk. To us, risk is the probability of a permanent loss of capital. That is the risk that you put 100 into an investment and you may not get 100 of that back. Now, in emerging markets, we have found that risk tends to manifest itself really in two key forms. It's poor corporate governance or it's balance sheet risk. And we think that markets are actually relatively inefficient at pricing both of those risk factors. So we take an upfront, diligent approach to addressing corporate governance and balance sheet considerations, ensuring that we have robust alignment of interests with the other stakeholders in the businesses that we're invested in order to create the environment for positive capital allocation decisions and real structural value creation over the long term. And it is that long-term nature, that long-term approach to investing in this asset class, which we feel really seeks to differentiate the offering that we have here versus other emerging market approaches. We are looking at companies as if we are long-term owners of those businesses, and we seek to own good companies over a 3-5 year and beyond investment time horizon, enabling the portfolio to benefit from the power of compounding of returns of good businesses that provide exposure to the attractive reinvestment opportunity that exists within emerging markets, and therefore driving sustainable rates of investment return over a longer investment time frame. This investment philosophy and process is really enabled by the investment infrastructure of which we're a part here at Fidelity. So the Fidelity Global Emerging Markets Fund benefits from a holistic approach to analyzing companies within the investment universe, leveraging the knowledge base of the 46 sector analysts on the ground in our offices in Shanghai, Hong Kong, Singapore, Mumbai, and London for emerging market equities, as well as leveraging the knowledge base of our broader portfolio management team, who in many instances have got decades of experience of investing in these marketplaces. Now, that institutional knowledge of companies within emerging markets is really critical to ensuring that we fully understand the nature of the businesses that we've invested in, to enabling us to understand how those businesses react in a variety of different economic conditions and really seeing how they've come through more challenging economic times and how that sets them up for future success. And it's leveraging that institutional knowledge of companies and bringing that to bear in a relatively concentrated, absolute nature of investing in the asset class with the Emerging Markets Fund that we seek to add value to our clients over the longer time frame. So what does that look like in a little more detail? We take a very absolute approach to analysing companies within emerging markets, and we really start with a thorough, robust understanding of the corporate governance structures of the companies that we've invested in, seeking to understand who we are invested alongside and what those other stakeholders define as a successful outcome for the corporate entity. We believe that the answer to that question will go a long way to determining how companies allocate their capital. And ultimately, it's long-term capital allocation decisions that determine the sustainability of returns and the sustainability of business models and ensure longevity of the companies in which we're invested in. Equally, we seek to understand management incentive structures in great detail to ensure that the managers of the companies that we invest in are properly incentivized to treat our capital with the respect that it deserves, but also to make decisions that are in the long-term interests of the health and sustainability of the company in question. We like businesses to have robust balance sheet structures, balance sheets that can support the reinvestment requirements of the company in question and really ensure that businesses are able to continually invest in their competitive advantages over the long term frame. We then seek to understand the sustainability of the return profiles of businesses. What is it that is unique about a particular company that gives it that competitive advantage that ensures longevity of excess profit generation and longevity of cash flow generation versus its peers? And then building a picture of how that cash flow can be reinvested back into the business. So how does this company grow over time through launching new products, entering new geographies, investing in new technologies? And over a 3 to 5 year investment time horizon, what does that lead to in terms of future cash flow generation? And how does that future cash flow translate into long-term intrinsic value creation for us, the shareholder? And it's through this diligent approach to long-term investing within global emerging markets that we're able to construct a high conviction portfolio of good quality stock ideas that really provide exposure to that attractive reinvestment opportunity that the asset class presents, whilst mitigating the exposure to the negative risk factors of the asset class, often related to governance, balance sheet and political risk that can create volatility and truncate returns for our clients. So what would the typical stock within the portfolio look like? One of the key positions in the portfolio is Bank Central Asia. It's a privately owned Indonesian bank. It operates in a sector which is dominated by large state-owned companies. The fact that this is a privately run bank has important implications for how they think about risk, how they manage balance sheet risk, how they think about the types of loans that this business is prepared to originate. Being family run, they know that they have to look to themselves to provide capital and support the business over the long term. And so they're very risk averse in terms of how they go about originating credit. What that has led to is very robust levels of capital, so very strong balance sheet, tier 1 capital ratios in excess of 23 to 25% versus industry averages in the 10 to 15% level, so significantly supported from a balance sheet perspective. They focus in on driving a very strong deposit-taking franchise, so having stickiness of client bases and security of deposits that provides financing to support the loan growth of the business over the long term. They also have very low cost of risk, so low levels of loan losses as a consequence of how they've originated those credits and ensured that they haven't lent to the more riskier infrastructure, long-term nature projects that are present within the marketplace. They tend to focus much more on consumer loans, working capital financing for clients that they know very well and where they have long-term relationships. When you put all of these elements together, what it creates is a business which is consistently capable of generating an 18 to 20% return on their equity base in a low-risk fashion, and that 80 to 20% return is realized by shareholders over the long term through ownership. Now, at the same time, the business has excess capital and excess funding available to it, which it can redeploy should economic conditions accelerate and the economic environment improve. And that therefore means that the incremental reinvestment returns are significantly higher than the 18 to 20% that the base business generates. And that creates that margin of safety and that optionality from a future valuation perspective that we look for in the good companies that we hold within global emerging markets. Now, that type of stock story plays out through other names within the portfolio. Whether it's a stock like Taiwan Semiconductor, which is the largest and leading manufacturer of semiconductor chips that go into all manner of different technological applications, and those applications are growing in terms of their demand for the high quality technology that TSMC delivers, that really cements their position as the leading player in the industry. It's not just Asia where we find attractive investment opportunities. You'll see stocks like Lojas Renner exist within the portfolio, the largest and leading apparel retailer in Brazil, a company which is a family-run business with a very long history of operating in the Brazilian economy, and a business which is consistently invested in its own competitive advantage, in its sourcing mechanisms, in its distribution mechanisms, and ultimately in its design mechanisms to ensure that the product quality is superior to that offered by its broader peers. It is a company which, because of its heritage and its balance sheet structure, which enables it to consistently invest in those competitive advantages, has consistently taken market share versus its peer group, and has left it in a position where, despite the challenges faced by the Brazilian consumer and the Brazilian economy in recent times, is still able to grow its business in excess of 10 to 15% per year in a very consistent risk-adjusted fashion. And it's through owning these companies over the long term that we're able to consistently generate, and we feel we'll be able to consistently generate robust returns for clients over the long term through businesses such as these. So, in summary, this is an investment approach which is firmly grounded in three key principles. We are very prudent in how we allocate capital. Strict focuses on corporate governance and balance sheet structures aimed at mitigating against potentials for permanent losses of capital. We're very focused in how we analyze companies, seeking to understand what it is that is unique about a particular asset that enables it to consistently generate robust levels of cash generation which are sustainable over the long term. We then focus on how that cash flow can be reinvested, what the level of return on that reinvestment is, and what that creates in terms of future intrinsic value. And then finally, we're patient. We're patient enough to hold the companies that we've identified as being long-term winners within emerging markets for long enough to enable the portfolio to benefit from the power of compounding of returns of those good quality businesses over a 3-5 year investment time horizon and beyond. From a performance perspective, we've been managing the strategy now for over 7 years. We've been able to deliver robust performance numbers throughout that time horizon, both from an absolute perspective in terms of absolute dollar returns, but also from a relative perspective when compared to the broader benchmark. I think it's also important, however, to consider the nature of where those returns have been generated from. Our focus on corporate governance and balance sheet structures and consistency of cash flow generation does tend to lead us to invest more of our capital in companies that exhibit lower corporate and lower cash flow volatility than the average stock in the investment universe. So whilst we've been able to deliver healthy absolute and relative returns, we've also done that in a very prudent risk-adjusted fashion with lower volatility of outcomes, which has helped to dampen the overall volatility experience that might otherwise have been witnessed in the asset class. And so those risk-adjusted returns over the time frame of managing the strategy have been very consistent as a result. So turning to the outlook for investing within the asset class. Global emerging markets are always susceptible to periods of volatility, and the environment that we're going through today is no different to that in which we've seen in certain instances in the past. Clearly, the recent outbreak of coronavirus has had implications for how we think about the investment backdrop as a consequence of the stalling of global economic demand that it is leading to, and the shutdown of supply chains and factories in China in particular that it has caused. Now, the market's view of this, and broader financial markets, have taken the view that we will look through some of the near-term challenges and really see this as a shorter-term hiccup in terms of the development of these markets. I think what we are really finding now, however, is that as this particular crisis rolls on and appears to become more elongated, it is presenting challenges in terms of financing conditions for certain businesses in China, and it is having more significant potential to disrupt global supply chains, which will impact the environment for earnings of companies in these sectors over the next 3, 6, potentially 9 months. Our personal view of looking through the opportunity set here is that once the virus is brought under control, which we fully expect it to be in the fullness of time, the monetary and fiscal response that we are likely to see from governments, particularly in China, is likely to be a positive driver of returns because of the economic activity that will therefore be created. We were seeing signs of that occurring throughout the second half of 2019, and whilst that may have been temporarily stalled, we think that over the long term it is actually likely that we see a continuation of those trends. Equally, the interest rate environment globally is likely to soften as a consequence of weaker economic data, and we fully expect actually to see further monetary stimulus from global players such as central banks globally, but also central banks within emerging markets. And we think that declining cost of capital will be positive for equity valuations over the long term within global emerging markets, despite the nearer term challenges and volatility that creates. Now, it is critical, however, to always have a well-diversified portfolio that is robust from the types of businesses that it owns, the governance of the businesses that it owns, but also the balance sheet structures of those businesses, in order to ensure that those companies have the financial strength to manage the near-term economic volatility and then capitalize on the opportunities that get presented thereafter. So that is a broad overview of the Fidelity Global Emerging Markets portfolio and the outlook as we see things today. If you would like more information, please do go to the Fidelity website or fill out the contact form below, and we'll be happy to engage with you in future on the portfolio. Thanks very much for your time.